Given the significance of the big action in Japan next week, let's talk about market positioning with Jason Ambrose, managing partner of Vanda Research. So there's been so much that's been analyzed over what might happen, what might not happen, and yet can it still be a game changer?
Well, it can be. It depends what you think about expectations. One, because it's not getting things right. It's getting expectations right where you make some money on these things, right? So it can be. The problem that we have with the Bank of Japan, it's pretty opaque. You know, that you've now got an expectation that's been built into the market about something fiscal, and whether that something fiscal is going to be tied to a bond issuance or a longer term bond issuance or not, because that makes a lot of difference. So, you know, there's quite a lot of expectation built around this meeting now. There's some people that still think that there's going to be a cut in interest rates in Japan.
Right.
If you don't get a cut in interest rates, then that's going to be very significant for how you would want to view the banks. But it also has much broader implications to global risk. I mean, what's been moving, say, the US 10-year bond, and that's the key benchmark risk for any asset manager. What's been moving the yield on the 10-year recently has been offshore Japanese buyers of US treasuries.
Right.
And that's been prolific. It's never been so big. So, you know, Japan is really, really important right now. It couldn't be more important, actually, for risk.
Does this make sense as to why Morgan Stanley is calling a bottom in U.S. 10-year yields? Next year, probably in the first quarter, they're saying 10-year yields, 1%. Is it because of this action that might happen in Japan next week?
I don't know, quite simply. I haven't seen the research. But what I would say to you is we're in a very unusual scenario where flows are driving the back end of the US bond markets. And if you know that flows are driving, that's something that's probably not going to change unless you get a serious announcement from the Bank of Japan. So that's why this thing's so important. If they come out and give you more negative interest rates, or give Japanese fund managers less reasons to think that rates at home are going to go higher, then yields quite simply in the US are going to stay lower. And yields will stay lower for an unusual circumstance. It will not be about US macroeconomics. It will be about Japanese flows.
So then this means that this bond market bubble that's been talked about for the past couple of years, it is nowhere near bursting.
I think calling the bottom of this is exceptionally hard, and we, like many others, have tried to do that. But what I'm saying is the story has now changed. It used to be a story of if you got US macroeconomics right, you kind of had an idea where the US 10-year would go. But now, because of globalization or because of central bank policies or both, that doesn't count so much anymore. So there's times when US macroeconomics does count, but the duration of those events is getting tighter and tighter and tighter. Whereas flows never really used to count. Now they account for nearly everything in terms of US treasuries.
And from market positioning perspective, does it make sense that what's been largely a defensive rally with utilities and telcos rallying 20%, this actually switches to risk on?
I don't think so, no, because look, quite simply, what moves cyclicals, the ratio between cyclical and defensive equities is its relationship with US rates, i.e. the 10-year. So if you've got an environment where the 10-year rates are still going lower, that tells you that the global fraternity is looking for carry. And if the global fraternity is looking for carry, then you're only going to see outperformance of defensive equities.
What happens to gold?
The gold is really interesting because there's two very different things that move gold is a function of real interest rates, and it does very well when real interest rates are low. So if you're in this interesting scenario now where the Fed, because of US data, it kind of wants to raise rates because non-farm payroll, if you look at it not on a last few print basis, but if you look at it over maybe a 3 or 4 print basis, it's been pretty good. US retail sales are good. You've even got the CPI that was okay. Everything in US macroeconomics is good. So the front end of the curve, yields want to try and lift, but the back end of the curve is still being suppressed by Japanese offshore buying of US treasuries. So you're getting this flattening event. And when you get these kind of flattening events, it means a lot for everyone. It means a lot for US banks. It means a lot for Singaporean banks. It means a lot for all of the different connotations to risk off of the back of that flattening structure.
All right, Jason, when we come back, we'll talk more about where EM stand amidst this volatility.